You're listening to the Lumina Podcast by Ad Valorem, where we shine a light on tax, business strategy, and personal wealth.
From running a business to planning your future, we bring real-world insight to help you stay ahead.
Let's get into today's episode. Welcome to the very first episode of our Lumina Podcasts. This is where we bring experts from the Ad Valorem team to come and talk about the more technical aspects of accounting and tax. Perhaps if we can kick off, Kate, with you saying what your day job is. What do you do day to day?
Yeah, so I advise on a variety of areas. It could be anything from private client work, encompassing, for example, if a client has sold a property, we also get involved in tax planning. And just to be clear, tax planning needn't be anything complicated. It could be, your basic tax planning ideas. We cover a variety of clients as well.
Yeah.
And we've got it on the subject, Nigel, of clients having multiple dwellings. Yes, we've got plenty of clients with multiple dwellings that we need to consider, but we also have a lot of clients with multiple sources of income. And just to give you an idea of the typical types of clients that we act for, and we may have clients that have run small owner managed businesses. Those clients would typically be employed by their company, so they would receive employment income, but they would also receive a form of dividends. We also have clients that may have secondary source of income such as investment income or perhaps part-time jobs. So we're
Huge range, isn't it?
Huge range of clients that we're acting for, and obviously the complexities for each client very much depend on their own personal circumstances.
So the innocent side hustle, which is the buzzword at the moment, can have much broader complications than just being a side hustle.
It absolutely can, and I think people that may think that something's a hobby and may think, oh, it's only a hobby. I'm only earning a little bit. It's fine. I don't need to do anything about that income. You need to be thinking carefully about whether or not there is a tax consequence of having that side hustle, as it was.
It's interesting. I mean, we're very much in that space ourselves.
Is property the biggest sort of secondary source that you see? Or?
Yes, property is just one example. As I mentioned, there can also be owner managed businesses where the directors, shareholders receive a salary and they will have secondary sources of income, such as it could be investment income, it could be a home that they're renting out. Obviously, we've also got several clients that are retired. They're receiving a pension, but they're also, they've got some kind of investment portfolio, as you expect, and they're potentially receiving dividends or, banking just on their savings. It's all those types of, aspects that we need to consider.
Yeah, I mean, certainly with the bank interest side, there's always the mix. I've seen a number of clients get confused where they've got ISAs, they're receiving interest there, as opposed to more savings interest and indeed income also from trusts.
Yes, I mean, just touching on the ISA point, ISAs are themselves, tax efficient investment. They're a way of investing very tax efficiently, and the income is kind of ring fenced in the ISA. So typically speaking, you wouldn't pay any tax on any, growth or income received that's within that wrapper. It's where a client might have investments outside a tax efficient wrapper that they would need to consider. Well, actually, what do I need to do about this? Do I need to be completing a tax return? Do I need to be telling the revenue?
And when it comes to experts that a client might want to talk to, where does it? I sometimes get confused with do you need to speak to a financial advisor, so an IFA, or where do you need to speak to a tax accountant?
Yeah, we work closely with IFAs, and obviously as a tax person, I'm not allowed to give financial advice, but certainly I can advise on the tax aspects of tax efficient investments. I think it's really important to have, an IFA supporting and your tax advisor who can run through the tax consequences of, making tax efficient investments and come to a collaborative decision as to what that client wants to do. It's very important that both parties are working together.
Well, I think it's a triangle, isn't it? Really, it's your accountant. If you're a business owner, it's your income from your business, so it's your accountant, your tax advisor, and your IFA that need to be working in harmony. Do you think it's the element of fees that puts people off actually, or just lack of perhaps understanding?
I think it's probably a bit of both fees, and a lack of understanding of potentially how they can arrange their tax affairs in a tax efficient way. And just to be clear, there's been a lot of talk at the autumn budget about tax avoidance and the revenue, the government are clamping down on it. But to be clear, what we're talking about here is we're talking about tax efficient ways of organising one's affairs. And every taxpayer has a legitimate right to organise their affairs in such a manner where it's tax efficient for them. There's a massive difference between what we call legitimate tax efficiencies and tax avoidance and evasion. And certainly there's been a lot of noise about that, but there are ways that a taxpayer can legitimately organise their affairs so that it's very tax efficient for them, and they can do that alongside an independent financial advisor.
And I think from our perspective, obviously we specialise working with family owner managed businesses, and you've got the immediate remuneration, but you've also got a broader aspect now, which is IHT, which the government seem to be progressively attacking. So you have to have that hat on as well in terms of generational wealth management.
Yes. Yeah, I think it's really important to not just consider the now, but to consider going forward. As you touched upon, Nigel, we've had a lot of recent changes planned for reliefs around inheritance tax, and that's the reason for all the lobbying that has been recently done by the farmers. The rates have been lowered. People that have worked all their lives are now in a position where the wealth that they have built up, in own managed businesses and farmers, that some of that is now going to be subject to inheritance tax. And it's really important that you speak with an expert, and that will be in conjunction with an independent financial advisor to get that advice as early as you can. And whilst the changes are not imminent, they're going to come around very quickly. And I think a lot of people make the mistake that, oh, I've got loads of time, it's fine. And then before you know it, a year's gone by and it's thinking, oh Christ, those changes are due to come in imminently.
I think it's a big thing, and I should just say on a non-tax related thing, we're continuing to lobby the necessary governmental departments on all cases for small and owner managed businesses. It's really interesting what you're saying there. I mean, again, I think the most common one that I see is, obviously, as Nikki mentioned, is property.
Yep.
We've got a property that we have outside. I mean, is there any, without giving specific advice, we've got one that we own, we take rental income from. What are the things you perhaps should be considering if you're thinking, should I be putting this into a limited company? Should I be thinking about a family investment company, which seems to be the buzzword that's going around?
Yeah, there's lots of aspects to consider, especially when you have more than one property. Obviously, if you were to own the property personally, then you're going to be paying income tax rates at the rates of 20, 40, 45%. Yes, you can think about a company, but it's not just as simple as, oh, I'm going to pop those properties into a company. There's things that you have to consider, but the tax implications of how do you get those properties into that company. And it's also thinking about the commercial aspects. It's not just governed by tax. There's tax implications, but there's the commercial aspects of potentially, I've now got properties wrapped up in a corporate environment. It might give you a bit more protection, but a key point to address is, obviously we've had the recent increases in the corporation tax rates. Now, it depends on individual circumstances, but if an individual needs to live off income, if they're living off that property income, then potentially having those properties wrapped up in a company may not be the most tax efficient way of dealing with things, because there's always going to be the element of double tax. That income is now not yours, it is that of the company. The company's going to need to pay tax at whatever the marginal rate is, and the rate of tax is now, the main rate is now 25%. So historically we've had 19% tax rate for several years. Now the corporate tax rate has gone up for companies. We've obviously got the dividend rate, so how are you going to get that income out in the most tax efficient manner? Salary dividend mix, but the dividend rates have gone up. So when you start accumulating all those taxes, so you've got the company paying tax, you've also got to get the money out via way of dividends. That's starting to reduce the tax efficiency of having those properties in a corporate wrapper. It's not to say you shouldn't do it, but it very much depends on an individual's, income needs as to whether or not that is.
Is it the number of properties as well? Does that have any bearing on it?
Yeah, I mean, certainly in terms of property income, what happens when you're an individual holding properties is all of that property income goes into one pot. You're taxed on your combined income. So it's not just properties, it's any other income that you have. That can start eating into your personal allowance. So for individuals where their income is over £100,000, you start to get a reduction in your personal allowance to the point where it's circa 125 that you lose your personal
It's about a
allowance.
65% tax rate on that band,
Yes,
isn't it?
yes,
Yeah.
it's a substantial amount of tax. So obviously, if you have, in answer to your question, Nikki, if you have more than one property, you're going to have start to accumulate quite substantial amounts of income. And when you're getting up to the level of losing personal allowance, then certainly potentially incorporating those properties, moving them into a company is something that you probably need to think about. Just need to be very careful of all of the tax implications of doing that move.
Yeah.
I think there's a bit of a misconception around, we'll just move these properties, we're paying lower rates of tax and it's all fine.
It's the proverbial my mate in the pub says, isn't it?
Yes.
And I think there's a really,
Yes.
really dangerous area.
Yes.
The enemy of the tax exercise.
Yes. I've had a conversation with my friend down the pub and he said, why don't you just put these properties into a company? Now, yes, you can do that. And that's why it's really important to speak to an advisor, tax advisor, before you go ahead and do anything, because we can be proactive and we can advise on the most tax efficient way to structure the transaction. But if you go ahead and do it without that advice, you could end up creating tax liabilities that you weren't aware of.
Yeah, I mean, I think the messaging coming through certainly in the short to medium term, tax rates are not going to come down. I think, Labour have done the heavy lifting in terms of putting some pretty onerous tax rates in. I think whether Labour stay in or whether Conservatives or whoever come in, they're not going to come in on the premise of saying we'll reduce taxes. The work's already been done. Why would you? So I think the combination of Lumina, the team we have with the private client tax, with an IFA,
Yes.
is a very, very efficient way of just making sure that you're ticking all the financial health sheets.
So property, I love property, so we've got to keep talking property. Holiday lets is something we love our holidays. Right. So this really interests me. So what's the difference between a traditional holiday let and an Airbnb or somebody renting out a room or something like that?
Yeah, so I think you've basically touched on a really key point, because in the tax legislation we used to have the definition of a furnished holiday let, and there were very specific rules around what qualified as a furnished holiday let. I won't go into all the rules because there's been a recent change in the tax legislation now, which means that the furnished holiday let rules are now abolished, and that's going to have a really big impact on those taxpayers that actually held properties that qualified under the furnished holiday let rules. So just to touch a bit more upon that. So the furnished holiday let rules were basically brought in by the government, and there were some tax efficiencies around those rules, and the tax efficiencies were namely around the fact that the furnished holiday let would qualify as a business for the purposes of certain capital gains tax reliefs. Also, the furnished holiday let rules meant that any income from those furnished holiday lets would count as earnings for the purposes of making pension contributions. So there were several key benefits that if a property qualified under those rules, you could get more beneficial tax treatment. Unfortunately, those rules have now gone. So as of 6th of April 2025, there is no concept of the furnished holiday let rules anymore.
Wow.
So that's quite a significant change. That's a really key point for any taxpayer that has has furnished holiday let rules, and basically what it means is that those properties that previously qualified are now in the same pot as your standard property income.
So it's a normal rental.
So it's a normal rental property.
Wow.
So what happens with the tax rules around normal rental property? All of the income from those properties gets put into a pot, and then you're taxed at whatever your marginal rate of tax is on that income. So there's no separate carve out anymore for furnished holiday let properties, unfortunately.
Wow, okay, that's a big deal. That's a big deal.
And is that the same for Airbnbs and?
So anything that may have qualified will now be just your normal rental,
just income,
rental property income. A key point in terms of rental property income, I think, is perhaps not thought about or is missed, is to do with mortgage interest relief. So historically, you used to be able to claim any interest on a mortgage that was used for purchasing a rental property. You used to be able to claim that interest as a deduction against your rental income. They've also been in quite a while, but I still think that a lot of taxpayers potentially aren't aware of the rules. But as of 6th of April 2020, the way that you obtain relief for mortgage interest is in a different manner, and it's much less tax efficient. So just to be clear, that's for individuals. So I'm not talking about companies here. I'm talking about individuals who own property, who have a mortgage on the property and who are claiming mortgage interest relief. You are restricted to the basic rate of income tax on that mortgage interest relief. Now that's just the high level.
Sure.
Obviously, as with
seems
tax,
unfair, doesn't it?
Yeah, unfortunately, it's a rule that it means that a lot of taxpayers are going to be paying more tax because they're not getting the generous relief. I definitely think it's something that taxpayers should be considering and making sure that they are aware of those rules and are staying compliant within those rules.
Yeah, tax is only going one way, and it's only been going way, and that's that way, isn't it? There just seems to be a lot of breaks elsewhere.
No.
So what would you do if you had misreported something? What would be?
So the key thing is to speak to somebody, as soon as possible. Speak to a tax advisor. They can support you with, declaring that mistake to the revenue and deal with it in the correct way. And I think that the point to make is it's really important to get to the revenue before they get to you. The revenue's powers of obtaining information are massive. It's very much Big Brother. And I was speaking to it was a family friend actually the other day, and he had an issue with his PAYE code. And I said, have you called the revenue? What have you done about it? He said, oh yes, Kate, I've called the revenue. I said, there's massive mistakes with PAYE codes. So I said, it's worth calling the revenue and speaking to them and running through it with them. And he said, he was explaining about the level of income that he had and that he was below the level of income to have to pay tax on this bank interest. And they turned around and said, oh yes, that's fine. We can take a look at your bank account, which, is
it's Big Brother stuff, isn't it? Yeah.
They have wide range of ways of obtaining information. So, for example, we've touched upon second, part-time jobs and hobbies. Any online websites, Etsy, eBay, online retailers. There's a way of getting information from those online retailers to find out who's been selling on their websites and catching people that way. So it's really important that if you think you've got any untaxed income, that you look at seeking advice on how to deal with that untaxed income. And if it's something that you've made a mistake on, then speaking to somebody so we can rectify the mistake sooner rather than later.
I presume that there is an aggressive penalty if you don't.
Yes. So the penalty regime is quite complex. It very much depends on taxpayer behaviour. So if you go to the revenue before they come to you, that is considered unprompted disclosure. And there is a difference between prompted disclosure. Prompted means the revenue have come to you and said, there's an issue. Unprompted means you've gone to them first. And the level of penalty is reduced where it's unprompted disclosure. It also depends on whether the revenue see that behaviour as careless or not. Typical penalties, to give you an idea, can range being between the range of 15 to 30%. It can be as much as 100%, but that's very, very serious. We're talking about very serious stuff, sort of fraud and things like that. But it's really important to. It's not just about the tax that you've got to consider. You've got to think about, the penalty.
And the interest rates, of course, have gone up as well.
Interest rates
used to be very, very beneficial. Now, far from it.
Interest rates, I think they're about 6.5%, 7%. So by the time you start doing the maths, if there's an undeclared source of income, and you've got to pay tax on that, it's not just the tax you've got to pay. You've got to start thinking about the penalties and the interest, and these could amount to substantial sums.
Yeah, I mean, it used to be a thing where certain scrupulous people would take a decision to say, well, the interest rate is low, I'm getting a much better return elsewhere, so therefore it makes sense for me to delay payment, etc. Not the case anymore.
No.
And definitely not the case of stick your head under a table.
No, it's
pick it up.
It's really, the sooner you get to the tax man, the better. There is you're likely to be able to agree a reduction in the penalties for unprompted disclosure, but also for cooperation. If the revenue are asking for information, yes, you have to check if they're allowed to do that, but more often than not, they will be. And it's really important to cooperate with the revenue, to give them all the information they need so that they're able to calculate the tax on that income.
So I know when COVID struck, I mean, I think they were much more approachable, I think, in doing time to pay arrangements. And has that got worse? Has that gone back to old days of perhaps not being quite so friendly and understanding? And
yeah, very much so. And I think when I was reading the autumn budget statement, I believe the figures were there's 44 billion of unpaid tax, £1 billion of unpaid tax, and I think half of that is about a year old. So yes, it is quite not to scare people. It is you're quite able to still enter into what's called a time to pay arrangement. The timescales for that time to pay arrangement are based on individual circumstances, but they're probably not going to be as generous as they would have done historically.
No. I mean, as I say, I know that's very much a fact of life, that they are being a lot more sort of aggressive, a lot more. I believe they have contractors as well who are incentivized to do it, and they really do not necessarily follow by the rules. So yeah, I mean, good advice. I mean, I guess to coin an Avanti West Coast thing, it's sort of see it, say it, and we'll sort it. Seems to be the thing.
Yeah, I mean, the two key points that came out of the budget were the collection of taxes and also tax avoidance and evasion. So those are the really key points. So it's not just about planning one's affairs in the most tax efficient manner. It's very much about the compliance aspect, making sure that you are declaring what you should declare. If you need to register for self-assessment, you register, or you get support with registering within the right timescales.
And if you sell something, so CGT, is there been any changes in that world?
So there's been, not so recent, but in 2020, the requirements in terms of if an individual sells a residential property have changed. So now the requirement is that where somebody sells a residential property in the UK, they have to declare the capital gain on a return within 60 days of that sale. That's really key. And to be clear, it's completely separate to self-assessment. So you have to declare the sale of the property and pay the tax within 60 days. But that doesn't negate you having to still declare that sale on your self-assessment tax return. So they're two separate mechanisms. It's very much Big Brother at the minute, and it's really
that's second properties.
So obviously, if you've sold your main residence, typically speaking, somebody that's selling their main residence that have lived in it throughout their lifetime is not going to pay capital gains tax on it, because they've sold their main residence, and you get what's called main residence relief. You might sell your main residence and then buy a new main residence. That's fine. There wouldn't be a reporting requirement on this. So the reporting requirement is typically for individuals that own second properties that they as an investment that they've sold.
Yeah, so on the main resident issue, what happens if you say you're living somewhere and that isn't really your main residence? I think was it Angela Rayner got caught on this one, didn't she? I think where she'd moved out of her main residence, and I don't know. I can't remember the details of it.
Yeah.
But
I mean, the main residence exemption itself is incredibly complex. I feel
Everything's
I feel like
complex.
that's what I'm saying at the minute. Everything's incredibly
Make
complex.
tax simple and it's probably will end up paying the right tax. But
There are various, is the straightforward situation is where you've owned a property and you've lived in it throughout your lifetime. It is categorically your main residence. Complexities start to come in to the mix when you might have a second property. The best piece of advice is if you've got a second property, you're thinking of buying one, then speak to somebody, before you do it, because there are, as with everything, there are certain timescales within which you need to be you must make an election, and if you miss that timescale, then you potentially might end up having to pay more tax.
And is there an IHT issue if the properties are over a certain value?
So in terms of the inheritance tax position, so any assets that an individual owns would be potentially subject to inheritance tax, subject to certain reliefs and exemptions. Every individual has a band of £325,000. So the way it works is you put all of the assets go into one pot, value all the assets, you see what that pot is, then you look at this nil rate band of £325,000. The point with the main residence is you can also increase that nil rate band if the main residence is left to descendants, family descendants, immediate family members, then that nil rate band can be extended by another £125,000. So an individual can have up to £500,000. Obviously, on the second death, if those nil rate bands haven't already been used, then the survivor will end up with potentially £1 million worth of band to offset against the value of their estate. One point to watch out for is where the estate is worth over 2 million, that £125,000 band starts to be tapered. So you get to the point where you might not end up with that 125,000 extra £1,000.
That's really interesting. So I guess, and this is not financial advice, I guess clearing your mortgage might be a nice
emotional thing,
an emotional thing, but possibly from a tax perspective is not the wisest thing to do if you have a property over a certain value.
I mean, the mortgage obviously is a debt to the estate, so that would go against as a liability and reduce the value of the estate. So all of these aspects need to be carefully considered.
And again, we mentioned it earlier with multiple incomes. IHT is one of those classic things that nobody actually really wants to talk about.
No.
But it is really important now that those conversations are had, because it's a lot easier doing it beforehand rather than after the event.
Absolutely. It's very difficult. If something's already in place, it's a matter of fact as to what the position is. It's all about planning and looking at your long-term plans. There are ways that you can legitimately mitigate inheritance tax in conjunction with an IFA. There are certainly conversations that should be had.
I know we always used to say, somewhat glibly, that IHT is always a voluntary tax. Almost a voluntary. It can be mitigated with proper planning, and that's another reason to be engaging with your tax advisor and a wealth manager around the same table at the same time, so that you have a joined up message.
So, question for you, Kate. Nigel's very entrepreneurial. So over the years, when he has had ideas for different income streams, he goes out and sets up a limited company. What have you got any tips on, obviously for people that are very entrepreneurial, what common things that can go wrong with how they might structure it? And I think one of the things commonly is perhaps when is a company dormant properly and when isn't it?
Yeah, it's a big one, because all like dormant, because they're great ideas. They just, when I actually come to look at them, I realise how unpractical they are. Have I got a tax problem with that?
Yeah, I mean, certainly when you start and talk about multiple companies, you need to be careful of the tax rates. So historically, the tax rate was 90%. There was one rate of corporation tax, and that, you didn't need to consider the implications if you had multiple companies. Now we have, well, actually different rates of tax depending on the profit levels of the company, but it also depends upon whether there are other what's called associated companies. Now, I won't bore you with all the technical details, but broadly speaking, it depends on what other companies that individual also controls, and that will determine at what rate of tax the company will pay. So in your case, Nigel, multiple companies, you need to be thinking, okay, do I need to start looking at the tax rates and the bands for companies? So we have a band in at £250,000. That band means that any company above that has got profits earning above £250,000 will pay tax at 25%. If a company's got profits in between 50,000 and £250,000, it will claim marginal rate relief, but it will pay somewhere between 19 and 25%. Under £50,000, a company will pay 19%. But the real important key point to take on in terms of those bandings are that those bandings, the £250,000, 50,000, those limits are reduced by the number of associated companies that a person has, i.e. a person controls. So in your case, the more companies you have, the lower the level of bandings are, but subject to whether or not those companies are dormant. So dormant in your eyes might not necessarily be the same.
Dormant in my eyes is a
But
good idea.
it's a good idea, but there is a specific definition for tax purposes, and funnily enough, that definition for tax differs to the definition for company's house.
Horror.
So company's house, you would probably submit a dormant set of accounts or a form to say the company's dormant, but that doesn't necessarily mean that the company is dormant for tax purposes. So it's, having multiple companies, the key point is, do they satisfy the definition of dormant for the tax man? And if they don't, then you're going to need those key bands that I've talked about, £250,000 and 50,000, you would need to divide that band by the number of associated companies that you have. And then you can see the effect of that is that the banding is starting to reduce. And that could potentially mean that where you've got a company that you think, oh, okay, it's not earning a lot, it should be within 19%, it's under 50,000. Well, because of the effect of other companies that you control, you might end up finding that companies is having to pay a much higher rate of tax. And another implication of companies and bandings and having associated companies is you need to look at the timing of the payment of tax. So we have this regime called the quarterly instalment payment regime. That's typically speaking for companies that earn over 1.5 million have 1.5 million, over 1.5 million in profits. Now that 1.5 million limit again needs to be divided by the number of associated companies. There are a few get outs. There's a period of grace. You need to satisfy certain conditions, but if you don't, that company could end up paying tax a lot sooner than the normal payment date, which is 9 months and 1 day from the end of the accounting period.
So is there, for me, I've got my dormant company.
Yep.
I'm not actually doing anything in it. It's
No.
just sitting. I've reserved a name. I could have a problem doing that.
You potentially could. I mean, if it's generally not doing something, you're probably okay. You would need to look at the company, need to look at whether it is generally dormant under tax legislation. Maybe consider just completely getting rid of, if individuals have got several dormant companies, you might wish to consider getting rid of it. Although I appreciate some people would have a company because they're holding the name.
Yeah.
So it's not just about tax. It's about, well, do I need this company? Why do I still have this company?
To be fair to you, that was the case with you on some of them.
Yeah.
Not all of them, but
Really good idea. So.
You don't necessarily.
but we were protecting the name.
If you're protecting the name, which you might
want to do,
might be, but it might be just looking at that saying, and it probably is in your case, they probably are generally dormant, in which case your bandings for corporation tax purposes are likely to be okay. I mean, we've talked about associated companies. So Nigel, in your case, I'm assuming these companies are all owned individually by you.
Yeah.
So they're not in a corporate
Nope.
group. Because that's the other consideration is when you're talking about having extra companies, how are you going to structure owning these companies? You might own them as an individual. You personally own the shares in each of these companies. They would still be associated. You might think about, okay, do I have a group structure? And group structures are very common in the tax world for tax efficiency. There's nothing wrong with having a tax group. It's quite common to have a holding company with companies underneath, subsidiaries underneath that company, and it's very tax efficient. Why is it tax efficient? Because there are certain attributes for companies that you can benefit from when you're in a group. So for example, you can move around assets, generally speaking, without any tax implications. If you have a holding company owning a trading subsidiary, you could potentially sell that trading subsidiary free of tax. Obviously, you've got to get the money out of the holding company, but there's benefits of having a group structure.
Yeah, I think naturally, I think entrepreneurial people want to do things quickly.
Yes.
They're passionate, enthusiastic, just want to get things
Yeah.
done. And really here we're saying perhaps take a step back.
Yes.
Even though you don't like it, you want to do things
You want to do
very
get
fast
things
paced.
done.
It could actually sting you in the
Yeah.
end if you don't
I mean, it's
properly
always
consider these things. Yeah.
Yeah, it's a really good point. It's always thinking about your future plans of structure. Yes, you might want to get that company set up, but should it be part of a group, a corporate group? Should it be a separate company? And there are tax implications. And particularly what you're looking at is there's tax, relief such as the business asset disposal relief and also business property relief for inheritance tax. If there are companies in the group, so it's in a corporate group, where there are investment companies, that can start tainting the trading status as a whole. So what the taxman does is they look at the group as a whole in the round and they say, okay, is this mainly trading? Is this mainly investment? If there's investment entities in the group, it could affect the trading status of the group as a whole, and that might be detrimental to certain types of relief. So it's a very important point to consider how it's structured. Is it better to have it in a group, or should we have separate investment companies? How are we going to do this? Now, obviously, it's important to mention if you do set it up in a particular way, it is possible to come and group it. Say like you set up a company that's not in a group, you own it personally. It is possible to group that company, but there's much more, hoops that you've got to go, hurdles that you've got to go through. You probably need to get revenue clearance. It's not to say that you can't undo it, but it's a bit more complicated, and vice versa. So you've got a company, you want to group it. Okay, that's doable. What happens if you've got a company in a group that actually you don't want it in the group? It's possible to do a demerger, and there are various reliefs. There's various statutory demergers that you can use.
As well, isn't there?
But again, you need to be careful. It's got to be for a commercial reason. You would have to get clearance. You can demerge investment companies, but that would come at a much higher cost. Because there's only certain types of mechanisms that you can use to demerge investment companies to make sure it's done in as tax efficient manner as possible. Any restructuring that needs to be done, it's strongly advisable to obtain revenue clearance, because what you don't want is to have a restructure and suddenly you've got, you come to sell that company in a few years' time, it goes through due diligence, and suddenly the potential purchasers are picking up problems with that structure.
We've seen that happen, haven't we?
Yeah. That's very common for, they'll start asking they might ask for the clearance from the revenue. Okay, where's the clearance? Where's the legal paperwork? It's really important it's done properly, because the implications of not having done a restructure properly are, potential income tax charge, potentially a chargeable disposal.
I mean, I think the thing as well, from a commercial rather than a tax perspective, we've seen a number of occasions where we've inherited clients from other accountants or whatever, and they've actually got the holding company as trading. which defeats the object somewhat, because the whole point is the holding company really should be there just to hold the shares of the subsidiaries.
Yes.
The minute you trade, you could put the company under commercial risks.
Yes. The whole point, other than tax efficiencies, the key commercial driver of having a group structure is risk. And typically speaking, it's quite common to have a holding company. And Nigel, yes, absolutely, that holding company would be there. It typically wouldn't do a lot. It would hold its assets, i.e. the shares in the subsidiaries. It might hold, land. A typical structure for example, in the hotel industries, you would have what's called a propco and an opco. That's the speak for basically having a holding company with a trading subsidiary. And in this example, the hotel itself would be held in the holding company. That protects the assets, and the trading company would be the one that runs the hotel.
That's where contracts are.
That's where the contracts are. So if there is an issue, then you're not pulling down the asset. You can, you probably consider liquidating the trading company, but you've still got protection of the assets in the holding company.
Brilliant.
Perfect. Thank you.
Great stuff. Been a really good session, Kate. I've learned a great deal actually as well, which is great. I really appreciate that. I think what we'd like to do, we're going to wrap up now.
Yep.
But before we do that, could we just a few quick fire questions, please? One of them, if you're a landlord who's got multiple income streams, what's a quick tip for you? What would you be saying to them at this in a sound bite?
For somebody that's got multiple income streams, I would say have a look. Check your mortgage interest relief. We've touched upon that. And also, is this the most tax efficient structure for you? Should you be considering, we touched upon incorporation earlier. Should you be considering moving those properties, getting advice and move those properties into a corporate wrapper? Might not be tax efficient for everybody, but it's certainly worth considering.
And most common mistakes, would you say?
I think the mortgage interest relief part. Just touching upon sales of property, I still don't think people are aware of the 60-day rule as well, and that's really important. And the fact that you've got to pay the tax within 60 days.
Brilliant. And then finally, just one reason to have a tax planning meeting.
Firstly,
that's a good question.
Firstly, making sure you're compliant. We discussed the penalty regime. We discussed, the implications of not disclosing income. But secondly, thinking about future structure, thinking about tax efficiencies. If you've got plans, speak to somebody now. We could look at structuring those affairs more tax efficiently, in conjunction, of course, with an IFA.
Brilliant. That's brilliant. So that about wraps up our very first session, Lumina Podcast. If you've really enjoyed this and got any comments, please contact us, and don't forget to subscribe at the bottom of the video.